Hi, good afternoon, everyone. Rob Lukey with Our Capital Group and Shop Prop Realty. I wanted to take a second to go over the S&P Case Shiller Index that was out today because it might confuse some people when it comes to the headline. The Case Shiller Index, as most people know, is the most widely used index when it comes to home prices in the U.S. And obviously the headline, home prices defy weak sales numbers, according to the S&P Case Shiller Index. So as we evaluate some of these things, what they're saying in this report is that there's been a slowing in the 20 and the 10 city composite, and is all that's actually happened is that instead of increasing and posting gains of an average of 13.1 and higher, we've seen that slow to about 12.9 per over year. And the reality is we're probably going to see that slip down into single digits, I would say probably mid-year, where we're seeing under 10% or maybe even 9% year-over-year returns. There's some good news about that. So what does this mean? Well, what you're seeing is that the rate of return, the increase in home prices, is starting to slow. That makes sense because we talked about this V bottom recovery way back when, that you would probably see this V bottom environment when it comes to home prices, and we've seen that occur. Now we're going to get back into more of a standard increase, which is somewhere around an average of 4 to 5% per year. Looking at some of the things, why it says weak sales numbers is because if you dig into not just this report, but you look at if you look at other reports regarding existing home sales and new construction starts, what you'll notice is that both new and existing homes are flat to down year over year. So even though you're seeing less sales occur, home prices still are showing a little bit of strength, right? Even though they've slowed, they're still showing year over year gain. Now, one of the things that I'll say is that one of the good news is part of the good news is that home prices nationally haven't made it back to the 2005 levels. So for us to move through this whole real estate cycle, you would anticipate at some point breaking out and actually moving up over the 2007 and 2008 levels. And that just depends on where you are, whether you're in the Bay Area, Los Angeles County, Orange County, or in the Seattle area. Those are the areas where we currently do business, when that market actually peaked. So what does this all mean? What it means is that you're still seeing strength. They're out of the on the Case Shiller, the January to February levels. You only had majority of the cities down, as you can see, month over month. So you're seeing this starting to slow, and I would say that some of that is good news from a standpoint that we don't want to see this continued move 24, 25, where we're going to then at some point have this bubble again and then see a 10 or 15% decline in a year. I would much rather see this thing slow down and slowly build up over a period of 5 years, 6 years to break out of that 2007 level. So kind of sticking with the initial thought was the V bottom recovery and then a choppy and ideally a choppy to recovery to slowly breaking out of those highs that we saw back in 2007 and 2008. Again, to continue to see this 2006 and 2004, if you look at this, you'll see that we were seeing returns of this, and that was an average in the city, in the 20 and the 10 city, that we were seeing 16, 17% returns per year in real estate. It's nice to see that we're stopping and hopefully moving back down into the 8 or maybe even the 7 and 6% range. Hope this helps. Going back onto Our Capital Group, if you do want to get involved on the investment side, you can always take a look at our site and go to OCG and then type in welcome, and you can see the properties that we're currently in, what we've done over the last year and 2 years and 5 years. If you want a free trial, you can go ahead and sign up with a free trial, or you can go ahead and obviously all our partners can easily log in. I did want to point out one thing too, and if you notice, last year we returned over 20% to our investors, so that's a pretty nice return last year for our investors, and that's after all expenses. As far as shop prop, I wanted to point out something. Here's one of our listing that is now pending, and this particular person, if you compare it to a regular full commission realtor compared to using a modern firm like Shop Prop, this client of ours is saving $52,000 in commission. And just to let you know, not only does that work on the sell side when you're listing your property, but the client that bought this property, had they used us, could have received back $52,000, because when you list a property for sale, you're going to pay something to the agent that represents the buyer. And in that situation, the buyer, remember, can get some of that money and get a large chunk of it if you use Shop Prop. Anyhow, go to our website. You can take a look at it. And if you have any questions, feel free to contact us here at our offices. Thank you very much.